You've probably heard that old saying, right? Don't put all your eggs in one basket. Well, it's more than just timeless advice. When it comes to your money, it's pretty much one of the most important ideas in all of investing. And today, we're going to break down exactly why. See, this isn't just some old folk saying. It's the perfect way to think about one of the most powerful strategies for building wealth over the long haul. And that strategy is called diversification. Really, at its core, it's all about one thing: spreading out your risk to protect your hard earned money. So, here's what we're going to cover in this explainer. First, what exactly is diversification? Then, why does spreading your risk even matter? After that, we'll get into the practical side, how to actually build a diversified portfolio. And finally, we'll talk about finding that all important right balance. All right, first things first. What in the world is diversification anyway? Let's get right into the foundation of smart investing. Okay, so here's the official kind of textbook definition. Diversification is just the practice of spreading your money out between different types of investments or asset classes. And the main goal here, the whole point, is to lower your overall risk. Think of it like a defense strategy for your money. If one of your investments takes a nosedive, it doesn't sink your entire ship. And when we're talking about all your investments, what we're really talking about is your portfolio. That's just a fancy word for the collection of everything you own financially. So that could include stocks like stocks, bonds, mutual funds, maybe some real estate, or even just good old-fashioned cash. So, how does this whole thing actually work in the real world? Let's dive into section 2, why spreading your risk matters. It really all comes down to the power of a concept called correlation. The real magic of diversification comes down to one simple but super important fact. Different investments react differently to the exact same market events. Not everything goes up and down at the same time. So when one part of the market is having a really bad day, another part might actually be doing great, or at the very least, just holding steady. And this is a perfect example of what I'm talking about. Let's say there's an economic slowdown. Those high-flying tech stocks, the ones that depend on big growth down the road, they might fall, and fall hard. But what about consumer staples? We're talking about companies that sell things we all need, like food and toothpaste. They often stay pretty stable. Why? Well, people don't stop brushing their teeth just because there's a recession, right? See how those two can balance each other out? It's pretty cool. So that relationship we were just talking about, that's what we call correlation. It's really just a simple way to describe how similarly two investments move together. And the goal, the secret sauce of diversification, is to own assets with low correlation. Simply put, you want investments that don't all move in the same direction. When one zigs, you want another to zag. That's what really smooths out the ride for you as an investor. Okay, so that's the theory, but how do you actually do this? Let's get practical. It's time for section 3, how to build a diversified portfolio. So imagine this is your portfolio. You're all in, 100% tech stocks. Now, you might have seen some incredible growth, and that's awesome, but you're also taking on a massive amount of risk. If the tech sector has a bad year, and trust me, it happens, your entire portfolio goes down with it. This is the absolute definition of putting all your eggs in one basket. So the big question is, how do we fix this? Well, it's actually a pretty simple two-step process. Step 1, you diversify across different types of asset classes. And then step 2, you diversify within each of those asset classes. Let me show you exactly what I mean. All right, step 1 is all about spreading your investments across those major categories. So instead of being all in on stocks, you'd add some bonds, maybe a little real estate, and you keep some cash on the side. Each of these behaves differently and has its own risk profile, and that gives you your first really important line of defense. Now, for step 2, which takes things a little deeper, let's zoom right into that stock slice of your portfolio pie. You don't just want one type of stock, right? You want to spread your money out within that asset class. So what does that mean? It means owning stocks from totally different industries, think technology, healthcare, industrials, and also from different parts of the world, international stocks. This way, if one specific sector gets hit hard, it doesn't take down your entire stock position. Okay, I know what you might be thinking. Does this sound like a ton of work? Like, do I have to go out and buy hundreds of individual stocks and bonds? Well, thankfully, you really don't have to. There are tools like exchange-traded funds, or ETFs, and mutual funds that are designed to do all this heavy lifting for you. These are basically single investments that can hold hundreds or even thousands of different securities all bundled together. So you get instant diversification in just one single purchase. Pretty neat, huh? But And this is a big but. Diversification isn't some kind of magic bullet that solves everything. And that brings us to our final section, finding the right balance and really understanding the limits of diversification.
So this all leads to a really common question I hear all the time. If spreading your money around is so great, does that mean the more investments I own, the better off I am?
Well, not exactly. The goal here isn't just to own a whole bunch of stuff. It's about owning a balanced mix of the right stuff. Balance really is the key. There's actually a name for this. It's called over-diversification. See, if you own too many similar things, you can actually end up diluting your potential returns. Your big winners get kind of watered down by all the other stuff you own. Plus, it can just get way too complex to keep track of everything. And here's the most important part. It still doesn't get rid of all the risk. A major market crash can still pull down almost everything. What's so cool about this chart is how it really shows you this idea in action. Take a look. You can see that adding those first few investments, going from just one stock to maybe 20, that dramatically reduces your portfolio's risk. But look what happens when you keep adding more. Going from 20 to 100 investments, the amount of risks you reduce becomes tiny. It basically flatlines. You get the biggest bang for your buck with those first 15 or 20 well-chosen, different investments. Now, of course, there are other ways to look at this. The legendary investor Warren Buffett famously said that diversification is a protection against ignorance. What he meant was, if you're a true expert who can pick the handful of huge winners, then you don't really need it. But for the vast majority of us who aren't Warren Buffett, that protection isn't just smart, it's absolutely essential. So, if there's one thing to take away from all this, it's this crucial point. Forget about trying to predict the future. Diversification isn't about guaranteeing that you'll always be right. It's about protecting yourself from the financial damage of being really, really wrong about any one single investment. And that leaves you with a pretty simple question to ask yourself. When you look at your own investments, is your portfolio a well-balanced meal, or are you just eating dessert?